Welcome to So in the Know. I'm your host, Sarah Ellis, Head of After Sales at So Resi, and today we've taken our podcast to the stage at the property event of the year, the London Home Show. Now, the London Home Show is effectively a one-stop shop for all of your shared ownership advice. There are some fantastic providers who are showcasing their beautiful homes. You can get mortgage advice, legal advice, so it's an event that is not one to be missed. Now, I'm joined on stage today by industry experts. Anthony Hall, if you want to give us a wave.
Hello.
Anthony is the director at Censeo, who provides shared ownership mortgages. And I'm also joined by Paul Kilshaw, partner of EJ Winter & Son, who are specialist lawyers. Now, for the audience, as I said, we will be taking questions as we go throughout the podcast today. So please do scan the app. If you could keep your questions relevant to the subject that we're discussing, it will help to keep the conversation flowing. Now, today we're going to be covering off applying, buying, owning and selling your shared ownership home. So we're going to take you through your entire journey. So let's start off with our first topic. What is shared ownership? What is it? Why do we even have this very unique product in our country? And actually, before we go into this, I'd actually like to put a question out to the audience. And just by show of hands, who is here today because open market house prices are becoming further out of reach? Okay, that's what I thought. So pretty much the whole room has put their hands up. And shared ownership effectively makes home ownership more accessible to more people. Shared ownership is when you buy a share in a home and then you pay rent on the share that you don't own. You also pay the deposit based on the share that you're buying, and you can buy more shares as time goes on. Now, shared ownership is now available up and down the country. Homes are popping up everywhere. So if you want to buy, but you simply can't afford to buy straight away on the open market, then shared ownership could be a really great option for you. Now, I'm quite mindful, as you are, I'm sure as well, that we've just had a change of government. We've got leasehold reforms coming into play. So I'm going to put this question to you now, Paul. Do you think that shared ownership as a product is here to stay?
Thanks, Sarah. The short answer is yes, but like all good lawyers, there's a long answer. And the reality is that I guess it doesn't really matter whether we have a Labour government or a Conservative government. There's a growing inequality in this country and throughout most countries in the world between those that have and those that don't. And properties generally, they're treated as an asset by those people with lots of money. So people with lots of money go out and buy properties, and ultimately what that's meant is prices of open market properties have been rising in the UK and Australia and America and everywhere in the world in the last 40, 50 years. So what like my parents and my grandparents could do would be to buy a normal house in a normal road on an average salary. That doesn't exist anymore for anyone. There's no reality of that now. So shared ownership is not just necessary today, it's more necessary than it was in those previous years. Now, you can argue about how you change governments and all that sort of stuff, and will anyone make a difference? But when inequality is growing, shared ownership is more necessary than ever, and it's here to stay. And in fact, probably you'll see the percentage of shared owners increase over the next few years as a result of that.
Thanks, Paul. And Anthony, we've seen lots of different products coming to the market. We had Help to Buy, which was also a great success. But are there any other products on the market that could be a good alternative to shared ownership?
There are other products. So you have something called discounted market sale, where the local authority and a provider will sell you 100% of a property. However, they will discount it by anything typically between 20 and 30% of the full market value. So that works for those who are not so far away from full ownership, but not quite there. So that is a product that is available. You also have the mortgage guarantee scheme. So there's 95% mortgages that lenders will give, where they get an insurance-backed grant from the government to offer you what they call a high loan-to-value mortgage. So you only have to put down a 5% deposit. Outside of that, there are other sort of rent-to-buy schemes that are available. So you can almost try before you buy. So you get like a discounted rent, and then the builder or developer will give you the opportunity to buy that property that you've lived in and rented for a period of time.
Thank you. I think the rent to buy is quite an interesting one to keep an eye on. There aren't many of these schemes that are available at the moment, and you usually have to qualify, so you wouldn't be able to afford to save for a deposit otherwise, and it's typically used for people who are actually trapped in that rental loop. But it is an interesting product.
Can I just say, in London, there's one called London Living Rent, as we're in London today, of course. The London Living Rent scheme gives you a 20% discount typically on market rent, and the provider then will give you a tenure. So you've got secure tenure on a lease to rent for that discount, and then they'll give you the opportunity to buy on shared ownership at any given time whilst you're living there, as long as you can afford it.
Great, okay. We're going to move on now to buying a shared ownership home. So Anthony, I'm going to keep it with you now. From a financial perspective, who is eligible for shared ownership?
So to be eligible, you have to be earning under a set income cap. So in London, it's £90,000. And if you're buying outside of London, it's £80,000. So you're not allowed to earn more than that. And that will be assessed during your qualification. You can't own a property either. So if you own a property now and you've got it on the market, then you can apply. But most providers will want to see that property is actually under offer. But you can't be an owner, and that is here or abroad. So you can't own a property anywhere. Sometimes people have commercial properties that they own as well. Again, if it's for business purposes, then there may be a way that the provider will allow you to do that. But if it's something that you own and you're using it as a home, then it's not possible. There are other criteria. Every provider will have different requirements in terms of their policy, but typically things like living and working is something in a particular area may come into the equation, but that usually is for a period of time. So it may be 3 months, it could be 6 months, but then after that it will open up to anybody to buy. But the general criteria is that you've got to be earning under the income cap and you can't own a property.
Thanks, Anthony. And when a buyer goes through their affordability assessment, because whenever you find a shared ownership home that you want to buy, you go to a financial advisor and they'll do an assessment for you. But Anthony, what is it that you're looking out for when you're doing these assessments?
Affordability is the key thing. So there are rules and regulations around what you can afford. So shared ownership is a government-backed scheme, so there are grants that are provided so that you get subsidised rent. Now, that means that they need to look after the subsidy. So what you'll see is your mortgage, rent and service charge that you have has to be under a certain percentage. Now, if you're buying in London, the target is 40%. So if you earn £1,000 a month, then your mortgage, rent and service charge can't be more than £400. That is the target that they're looking for. Now, there are circumstances where you can exceed that, and the mortgage advisor will assess your ability to see whether or not you can afford more than 40% of your net income. But typically, again, every provider will have their rules and guidelines as to how far they're prepared to go above that 40% guidance.
Thank you. And if I can give anyone a word of advice here today, is the market isn't quite like what it was last year. We've had the scrap of Help to Buy. There are more shared ownership buyers in the market at the moment, and there's fewer stock. We used to see around 2,000 to 3,000 buyers contact us every month. We're now at 4,000 to 5,000, so it'll give you a bit of flavour for how busy our phone lines are at the moment. It is a lot busier, so I would recommend that you get your paperwork in order early doors, so if the provider does have a first come first serve policy, you're ready to go. But just talking on deposits now, what sort of deposit would you expect to put in?
So the minimum deposit typically is 5% of the share that you're going to purchase. Now, the minimum share will vary. So on your existing property, so resales, for example, it will be the share that that person currently owns. And that could be anything from 25% up to 75%. So you would buy what they're selling. If you're looking at a new build, it's either going to be a minimum of 25, 30, 40%, depending on what the developer is selling, or they may set an actual 10% minimum, which is based on the lease that is provided. Now, that 10% on what you actually buy is going to be assessed by the advisor. So when we do your affordability assessment, we will confirm what share is affordable for you. So there isn't a one size fits all. It is down to your individual assessment, and then your deposit is based on the share. Now, there are lenders out there that will actually offer a 100% mortgage, but most providers will restrict you from using that. They want you to put down typically a minimum of 5%. If you're on a visa, sorry,
Sorry,
just going to jump in. But if you're on a visa, your deposit level can be higher. I don't know, I think it's probably a question about visas later. But if you're on a visa, your deposit level could be as high as 25% of the share value.
What if you can afford to put in a lot more, though?
Go for it. The bigger the deposit, there is no restriction on what deposit size you put down. The only thing that will be assessed is two things. A, the bigger your deposit, the bigger the share that you probably be able to afford. But then also, do you need shared ownership? Because if you've got a share that means you can go on the open market, typically the providers won't allow you to buy shared ownership. You've got to have the need for shared ownership.
Thanks, Anthony. Anthony just touched upon a resale there. Now, that's our own internal terminology for a pre-owned property, so much like you'd see on the open market. When a shared owner goes to sell their home, we call it a resale. So it isn't just new build. I know all the marketing is quite tailored to new build homes, but there are resale homes too. We advertise all of our properties on our website. Easy one to remember, sharedownership.co.uk. You can search for new homes and resale properties, so there's plenty there to choose from. But Anthony, when you're looking at monthly costs, if you're comparing monthly costs for a new home compared to a resale, is there a difference?
Generally speaking, the service charges are slightly lower on a resale, typically. We do find that. But it depends, because you're potentially buying a higher share on a resale. So although the open market values are typically lower, you might find that the rents are slightly higher on a resale. But from my perspective, I do find that the monthly payments usually come out slightly cheaper on the resales, because the values are slightly lower. Because when you buy new build, you pay what they call a new build premium. Very similar to buying a brand new car. You buy an extra premium because the car's new, it's nice and shiny, you're the first one to own it. It's just very similar when you buy a new build property. It's called a new build premium. So it is a little bit more expensive. My advice is get an affordability assessment. So before you make that decision, do you want new build, do you want resale? Understand where your affordability sits, know the value of what you can go up to, then you can go and explore whether or not the new build or the resale is the best fit for you in terms of affordability.
Perfect, thanks Anthony. Now, just in terms of service charge, I know you mentioned it, and there's been a lot in the press about service charges. Paul, for anyone who is concerned about monthly costs, is there anything that people can bear in mind when they're looking for a home?
Yeah, thanks, Sarah. I mean, service charge is quite a difficult area because it's quite wide to sort of discuss. But generally, on service charges, people tend to go and they look at new build properties and they see concierge. They see a pool room, a gym, facilities, lifts. All of that stuff costs. And whatever you've got in the building that you're buying, you're paying for. And there's no third party out there that's going to come along and say, we'll cover the cost of the gym or we'll cover the cost of the concierge. The residents, the owners, the shared owners of that building are paying to maintain that building, and they're paying for those services. So I think most people just sort of look at things and say, oh, it's brilliant, we've got a swimming pool, whatever the services are, but actually you've got to pay to maintain that. So that's going to increase your service charge. So to keep service charges low, personally, I wouldn't be looking for a concierge. What's the point of a concierge? I mean, it's great when they take the Amazon parcel in, but other than that, they're getting paid whatever they're getting paid. Lifts, sometimes you can't do without lifts, but equally lifts break down all the time. They have service contracts. There's loads of issues with that stuff. Gyms, they're great, but I don't use mine. You want to use it, but you don't go because you never get the time and you find an excuse, right? So why are you paying for it? So I think with service charges, people need to be looking at what the services are and then understanding if the CCTV, you're paying for it. Everything that's being provided to you, you're going to pay for it. And therefore, that's going to increase your service charges. So if you want to keep them down, try and find buildings without huge amounts of those services. And if you want a gym, go and join a gym.
Some good advice there, Paul. Thank you. We've actually had some questions coming in. And for you, Paul, when someone has found the home of their dreams, how long does it take to go through the legals before you get your keys?
You're not going to like it. I mean, to be truthful about it, it depends on whether you're buying a new build property or a resale, so second-hand property. And it's crazy, this statistic, but we looked the other day because I knew I was coming here, so we had a quick look. And on average, it's about 5 to 6 months from the point at which you offer on a second-hand property to the point at which you get the keys. And that sounds crazy, and I said you wouldn't like it, but that is the reality. The reality is that all shared ownership is leasehold. So every time you buy a shared ownership property, it's a leasehold property. And all leasehold properties in the market are difficult to do the conveyancing on right now. There are loads of reasons. We could sit here for a whole podcast and discuss even one of those reasons. But the time frame is a bit longer than you probably expect. Having said that, that's the same time frame if you're buying 100% of the property and it was leasehold as well. So there's no difference in time frame. It's just the conveyancing process over the last 10, 15 years has got longer and longer and more difficult. Now, you might get lucky and you find one where everything's perfect and everything lines up and you can be in a month. They're rare. I say, I sort of would rather overpromise and then under-promise and deliver than try and over-promise to you. So I think reality is if you're looking to move and you want to move in 6 months' time, you find something now. You can't go and buy. It's not like buying a car where you go and buy it and next week you've got it. And of course the other difficulty with new build is it depends when it's built. So often, the developers are selling this stuff off plan, so it's not fully built. So you then exchange contracts and commit and you have to wait for it to be built. So it depends on the property, but on average, just like all leasehold transactions today, 5 or 6 months.
And it's almost why I encourage you to do an affordability assessment as soon as possible. So once you know what you can afford, then you know what sort of timescales you actually want to move somewhere. You can then start to save towards a deposit, speak to friends and family if you need to be getting gifts. Then you can then start to work out, right, I actually want to be in before Christmas, for example. So then you're probably not going to go for a resale property because you're not going to be in before Christmas. You then might want to look at a new build where they've actually got what they call practical completion and they've got the keys for it. So as soon as you've got your mortgage and your legal work done, you can move in. And we've seen those being done in under a month. So it is possible.
Moving in, that's going to take us on nicely to our next topic, which is the lived experience.
That wasn't planned, by the way.
we rolled it in quite nicely. Now, obviously, it's wonderful, it's exciting. You're buying a new home or a resale home. But what does it really mean to own a shared ownership home? Now, Paul, again, I know this is really, really difficult to summarise in the short time that we've got. But what is a shared owner's legal responsibilities?
Yeah, so I mean, when you buy a shared ownership property, you acquire a leasehold property, and with that leasehold property is a lease. And a lease is a bit like a 45-page document that says your rights, responsibilities, what the housing association's rights and responsibilities are. In essence, you buy a percentage of the property, so 25%, 45% or 50%, whatever, and the rest is owned by someone else. So you own your share, someone else owns the rest of the share, and you pay rent on that. Now, one thing that people don't always understand is that when it comes to paying things like service charge and maintaining the property, looking after the property, etc., generally you're 100% responsible. So you may own 50% of the property, but you're 100% responsible for the maintenance of that property. So that's one of those things most people don't fully understand. Having said that, you have complete control of that property. So unlike when you rent a property, you can't paint the walls, put a nail on the wall. The landlord wants it back, so they serve you a notice or whatever. It's yours. There's it's control. With a shared ownership property, you only own that percentage, but you then control that property, and it's your property, other than paying the rent and the service charges that go with it. But it's always leasehold. And as it stands today, and I think we've talked about this before, where I'm not a lover of leasehold. We're the only country in the world now that really has leasehold left. Everyone else has some sort of version. America have their own version. Condominiums. Australia have their own version. Everyone has a different version, but we're left with that as a legacy of our feudal system from William the Conqueror. So we still have leasehold properties, but as far as leasehold properties go, shared ownership are the better end of it, because with a shared ownership property, the other part of the property is owned by a housing association who are not for profit. And so that's the better end of leasehold as far as you can get leasehold. But ideally, in the ideal world, we'd never have leasehold again. But we're stuck with what we've got right now.
We've got a couple of questions coming in for you now, Paul. What happens if you need to move out for a while, if you need to sublet or get a lodger? Can you do that with shared ownership?
Yeah, so you have to look at your lease, and historically there's been 3 main leases, though there's other leases, other types of leases. And what's happened is over the years, the Housing Corporation or the Homes Communities Agency or whoever now runs this have changed the wording in the leases. On the very latest shared ownership lease, if you buy a new build property, you can ask for consent to sublet. And there are certain criteria where that will be permitted. On the older leases, it clearly says that there's no right to sublet. However, you could still ask to sublet, and depends on your circumstances. I think there's a special priority for people in the forces, for example, in relation to subletting. But what you can do is you can take a lodger in. So if you're living in the property, you can take a lodger in without having any special consent. But you would have to look at the lease. And as I say, there are 3 main leases. The current lease that you enter into if you buy a new build property is frankly the best there's been so far, and there are many advantages to having that lease over the older leases, one of which is subletting. Although you don't have a right to sublet, you have a right to ask to sublet, and as long as you fulfill the criteria, I believe it is normally granted.
Just to add on that, if you are subletting the property and you're granted permission, you also have to seek approval if you've got a mortgage from your lender. Because under the terms of the mortgage that you'll be taking out, you will be living in the property as a residential mortgage, and if you're not obviously going to be doing that, the lender will need to be aware, and they will grant you permission.
Thanks, guys. One of the other benefits of having a shared ownership home is you don't have to stay with the share that you've got. So over time, your financial circumstances might change. You might get a promotion, you might come into some money, you might form a relationship, get your partner in on the mortgage with you. But you can staircase and you can buy more shares as time goes along. Now, there are costs associated with staircasing, so you'd need to get a RIC survey and you'd need to get a lawyer to do all of the legal paperwork for you. Some housing associations or registered providers will provide some sort of incentive or help. We often send a £500 contribution towards those costs. I can't promise that's going to be there forever, but it's something that we do occasionally to help people with that outlay of costs. But we help hundreds of shared owners every year staircase to 100%. That's not the only route to full ownership, though. Sometimes when a shared owner then goes to sell, they then go and buy on the open market because they've made some money on the share that they own, and they've then formed enough of a deposit to go and buy on the open market. So it's 2 different routes to home ownership. But Anthony, in your experience, is there a better time to staircase?
Than now, or
just in general?
In general. The best time to staircase. I get asked that a lot, actually. When do I buy more? When you take out a mortgage, typically you're going to have a fixed rate for 2 to 5 years, generally is what people do, especially first-time buyers. We would review that mortgage when your fixed rate ends. That is probably the most suitable time to start looking at whether or not you can buy more shares. But I would say if we go right back to the beginning, when you bought in the first place, the mortgage advisor, when they do your assessment, they will then work out the share that's affordable for you. A conversation should be had at that point as to what your plans are for the future. So if trying to get up to 100% or 60%, whatever it is your desire, we will discuss a plan. So we'll say in 2 years' time, when we look at your rate again, we'll have a look and see whether or not you can buy another 20%. Or whether or not you can buy another 10%, whatever it may be. So there has to be a plan in place. And I think if you do that from the beginning, it makes it a much smoother journey to staircase and actually more affordable, because you know you can save for it and plan for it. If you're getting gifts from friends and family, like I said earlier, you can butter them up and say, look, in 2 years' time, I'm going to need 10 grand because I want to buy some more shares. So you can start planning for that. So I think the best time, in my advice, is when you're looking to remortgage. Every time you do that.
Yeah, I'd have to agree. So you've found a home you love, you've bought it, you've lived in it, now it's time to sell. So let's get stuck into the subject of selling. Now, housing associations or providers have a set amount of time when you go to sell your shared ownership home to find another shared owner. We ask of this because you've all had an opportunity to buy and get your foot onto the property ladder, and we just ask for a set amount of time to find another shared owner to have the same opportunities. Now, if the provider isn't able to find another shared owner within that set time, you're then free to do as you please. You can go and employ a high street agent. So Resi actually have their own in-house estate agency, and if you don't want to go off to another estate agent, you can actually list it for 100% with us as well. But Paul, what should shared owners be thinking about when they're going to sell?
Well, unlike where you own 100% of the property, you can't just go back onto the market with your local estate agent, like Sarah just said, and put whatever price you want on the property. You've got to offer it back to the housing association, and it depends again on your lease. There's these 3 main leases, and one of them says you've got to give the housing association 12 weeks. One of them says you've got to give them 8 weeks to find a buyer. One of them says you've got to give them 4 weeks. But the point really is that you can't just go and set the price yourself. I think it's worth 350,000 and this estate agent's going to sell it for me. Well, it depends upon the valuation that you have on the property. So you have an element of not being able to control that for that period. Once that period's up, if the housing association doesn't find you a buyer at that agreed price, you're free to do what you want. Then you can put it on the open market, find a buyer. You can sell 100%. You may only own 25%, but you could decide, I want to sell 100% on the open market, and on the completion, so on the day of moving, the buyer will pay 100% of the value. You'll effectively staircase, so acquire the other 75%, and you sell 100%. Obviously, I believe the idea is that the idea is to try and keep the percentages fairly low to keep that in the shared ownership stock, because what tends to happen is when you staircase to 100% and sell that property, someone outside of the shared ownership community, if you want to call it that, will buy that property, and therefore that kind of defeats the purpose, I guess, in a roundabout way, but that's a different argument to have. But the key thing is to know that you really need to take advice from your housing association provider about what you can do. Don't just go on the market. We see so many customers that have just gone straight to an estate agent, and they shouldn't have done that, because it's not a valid sale at that point. They must follow the process in their lease.
And the other tip I could probably give you today is make sure that you choose a lawyer who understands shared ownership. Paul was talking earlier about timescales, and we certainly see a difference in timescales when you're using a solicitor who doesn't understand shared ownership compared to a lawyer who does. So it can take considerably longer if you do appoint someone who doesn't understand it. Paul, what could people ask when they're appointing a lawyer? What could people be asking to find out if they are an expert?
Yeah, it's a really easy one, and it's stamp duty. So to be frank with you, there's an adage that says that 99% of lawyers give the other 1% a bad name, which is kind of true. And in relation to shared ownership, there's very few solicitors that specialise in shared ownership. There's probably 10, 15 firms that do it. So stamp duty is an easy one to find out if the person you're speaking to understands, because stamp duty depends upon whether you're buying a brand new property or whether you're buying a second-hand property. And if you're buying a brand new property, you actually have a choice on stamp duty. You can choose to pay stamp duty on the full market value, so an election to choose on the full market value, i.e. the total price of the property if it wasn't shared ownership, or you can choose to pay stamp duty on the percentage you're buying and the rent. The reason why you sometimes choose to pay stamp duty on the full market value is because at the moment stamp duty rates for first-time buyers are really favourable. It's up to $425,000 with no stamp for a first-time buyer, And if the full market value is below that, you'd pay no stamp duty anyway. And if you then staircase in the future, you'd also pay no stamp duty. Whereas if you, so most lawyers that don't do this daily have no idea about that. So you ring them and you say, I'm buying this property. They say, what's the price? They give you a quote, but they don't tell you about the stamp duty. And that will dictate whether someone understands the process or doesn't understand the process. The other thing is, if the quote's too good to be true, it's too good to be true. There's no such thing as a free lunch. If it's too cheap compared to everyone else, they probably don't know what they're doing. Because there's a reality, there's a cost behind this. It is going to take a number of months. It might be quicker than I've said, but it's still going to take a period of time. And there's cost to this. It can't be done for a couple of £100. So they're two sort of tips on looking at your lawyer.
And Anthony, is there anything that you could advise for anyone thinking of selling?
Speak to a broker, because I think if you're looking to buy somewhere else, typically people are upgrading. So you're moving from a flat to a house, or you're going from a 3-bedroom to a 4-bedroom, 2 to 3, whatever it may be. But your finances need to be in line as well, because that sale, you may be needing that money to use part of your deposit to buy somewhere else. So the advisor will be able to advise you on what your numbers look like. So before you even put your property on the market, speak to the broker about what it potentially is worth, what equity. So when you sell your property and you pay off your mortgage, what's left is your equity. That will be used to form what you can afford moving forward. So I think your relationship with your mortgage advisor is one of the most important that you're going to have, because potentially if you take out a mortgage now, the average mortgage term is 30 years, but you're not going to necessarily stay in that property that you buy for 30 years. But that advisor can be with you for multiple property moves. I'm not quite sure on the stats of how many times people move in a lifetime, but I reckon it's at least 3 to 4, I would imagine.
Yeah, okay. Great advice. Thank you, Anthony. And I think that will move on to some questions that I think we've got time to now tackle. Someone has asked, what happens if the value of your property depreciates? Really good question. We've just seen, a COVID pandemic. We had the rise of interest rates. There are some areas in the country who have seen values going down. It's a really good time to staircase, to be honest with you, because if your property is going down in value, it means the shares are going down in value too. So if you are able to stay there a bit longer and hold out to see what those values are doing, and you are able to staircase, it's actually a really good time to staircase. I don't know, Anthony, if you've got any thoughts on that?
I was about to say, it's actually, what you said is, I agree 100%. It's almost one of the benefits of shared ownership. I always call it like a bit of a seesaw. So if your valuation is going up, you're getting that gain. You're gaining equity on shared ownership. If it comes down, great time to try and buy more shares, because you're buying more for less. And if you're in the property for long term, then obviously that makes sense. If you're planning on staying in the property for a couple of years, then staircasing and buying more shares is not for you. And if the value's coming down, not great. Obviously, we wouldn't encourage people to sell for less than what you've obviously purchased for. But that's no different to if you buy on the open market. So the key thing there is, if you're worried and your value is going down, speak to your advisor, who will be able to give you the best advice as to whether or not you should look at staircasing or not.
Another question for you, Anthony. Questions come in about ISAs.
Yes. So the Help to Buy ISA is now actually closed. Anybody got a Help to Buy ISA? Yeah. So if you have your Help to Buy ISA, you can actually still use it. However, it will close. You have to use it by 2030. The Help to Buy ISA, you can't stop. You can pay up until 2029 and then use it by 2030. £200 a month is the limit, and you'll get your 25% bonus. So that's there. If you've got it, great. For those of you who haven't got one, you can get a LISA, which is replace the Help to Buy ISA. Now you can use that to buy a property of up to £450,000. Now, obviously, those of you in London thinking you want to buy one, 450 may not get you a lot, but that's the current cap on the LISA. And you also get a 25% bonus with the LISA, up to a limit of £1,000 a year.
Another question for you, Anthony. There's a lot of questions on mortgages coming in today, but
as always,
where can you go to get a financial assessment, an affordability assessment?
So Censeo Financial is the company I obviously work for. We do assessments every day, but there are a number of mortgage advisors who specialise in shared ownership who are able to do an assessment. But I will stress, of course, Censeo, we do that. You have to use a specialist broker to do these assessments. Your mortgage advisor, if they don't specialise in shared ownership, as we said earlier regarding the legal side of things, if you're not a specialist in it, you're likely to get that affordability assessment wrong, because you're not doing it day in, day out. And there has been some recent changes outside of London. Homes England, they, as I said earlier, they do all the regulation. They've changed the way the affordability is assessed, and it actually is stipulated within the guidance for housing associations who do shared ownership that people should be referred to a specialist and somebody who's knowledgeable in the field of shared ownership. So Google's obviously your friend. You can Google shared ownership mortgage advisors. A range of brokers will come up that do shared ownership. We do it, of course. And I think the key thing is, and I said it earlier, that assessment is probably the key to your journey and should be the beginning bit. I know a lot of you have come here to see what's available in terms of properties today, but make sure you leave and speak without, don't leave without seeing a broker. It's really important that you speak to them.
Fab, thank you. Thanks, guys. Thank you for joining me. And that's all we've got time for today, I'm afraid. But thank you to the audience for being so engaged. Thank you to the London Home Show for having us today. And thank you to my guests. You've been amazing.
Thank you.
Now, if you've got any questions that you want to ask, please feel free. Come find us at the end of this session. But otherwise, thank you, everyone. This is So in the Know.